child and dependent care credit. So notice they don't just say child care credit, it's child and dependent care credit. That means it doesn't have to be a child. It's just that in most cases, it's gonna be a child. There are, we have to determine what qualifying expenses are and who a qualifying individual is for purposes of this particular credit. So qualifying expenses are expenses that you incur, necessary expenses that you incur for the care of a child or a dependent so that you can work. That's important, so that you can work. So if you and your spouse are going out for dinner and you get a babysitter, those are not qualifying expenses because you're not going out to work, right? So there is a work component to this. Now, what if you're going to school instead? You're a student, full-time student, you're going to school. There is an amount, they do deem a certain amount of income to full-time students. $250 for each individual child or dependent per month, up to 2 children. So $250 or $500 a month for the months that you were attending school. So if you weren't attending school during a particular month, that month would not be included. I'll show you an example of how that works. But so the credit only applies if you are going to work at the time or you're going to school at the time. It could be a daycare facility. It could be an individual. It doesn't, if you pay grandma still counts, right? You can still, if you are paying that individual in order to go to school or to work. Qualified individuals, so if it's a child, they have to be under the age of 13 and a dependent. You're dependent on the tax return. So once they turn 13, they cannot, any expenses incurred for their care are not eligible, they're no longer a qualifying individual, okay? Now that is, it's not that so if they turn 13 in August and they were in maybe after school care and summer camp so that you could work up through, or it was for the full year, you can count the time from August to January for the credit. But once they turn 13, none of those expenses, they would no longer be a qualifying individual. They can be over 13 if the dependent is incapable of caring for themselves and they lived with the taxpayer for at least half of the year. So many would argue that 13-year-olds are still incapable of caring for themselves. I would be one of those people. However, they would not be considered incapable of caring. They can keep themselves alive. Can they keep their sibling alive at the same time is the real question. That one remains to be seen. All right. Usually, individuals who are married filing separately usually cannot take advantage of the dependent care credit. So you do have to be married filing jointly. There are some instances where there's an exception to that, but for the most part, that essentially if they would qualify as head of household, they're married filing separately, but they would qualify for head of household, then they can take the credit. But under those limited circumstances. Okay. So for tax year 2021 only, this credit became a lot more generous. Naturally, because this is the year that I could no longer take it. So it became more generous when I couldn't have it. It's going to go back to the regular, the pre-2021 rules this year. But so how much can you take for the credit? The maximum amount that you can take is $8,000 per individual, qualifying individual, up to 16,000 for 2 or more. So if it's 1, 8,000, 2, 3, 4, 5, 17, it's 16,000 is the most that can, now that's not the amount of credit. Those are the expenses that qualify, okay? Which is much more reasonable than it used to be, and then it will be again because it was 3,000 or 6,000. And those of you who have children know that it's impossible to have at least full-time daycare for $3,000 a year. At least it's not daycare you want for your child. So they're also, this is the upper limit. There are additional limits based upon the earned income of the taxpayer. So there is a phase out amount to this credit. It's a really high phase out amount. So what we're going to do with this credit is we get a percentage of our qualifying expenses. That percentage that we use is going to be based on this table that I'm going to show you. So, we'll come back to those examples here. Here's the table. It starts out, so if your adjusted gross income is $125,000 or less, you multiply the qualified expenses by 50%, that's the amount of your credit. And this did become a refundable credit as well. So if you qualified for $16,000 of expenses, you've got 2 kids, you get an $8,000 credit for those child care expenses. So the federal government's picking up the tab for half of those expenses. That percentage goes down, though, as you proceed through the income. As that income goes up to 438,000. Once your income reaches 438,000, again, this has to be earned income. You have to be working. Then you get no credit. So it phases out at that point. So like I said, it's a pretty high level to phase out at, but it does have a phase out to it. But anything below 125,000, and again, it doesn't matter this is the AGI amount, and it doesn't matter the filing status. This is for all filing statuses. Okay. Additionally, it is also limited to the amount of earned income from the lowest earning spouse. So if married filing jointly, one spouse earns $300,000, the other spouse earns $2,000, the limit is now $2,000. The lowest earning spouse. The earned income from the lowest earning spouse is what's going to be the limit. So even if you have 2 kids, otherwise you would be entitled to the $16,000. You're only entitled to the $2,000. Let's look at a couple of these examples for the limitation. So we got Bill and Susie. They each earned $120,000. So $240,000 in total. They paid $21,400 for qualified employment-related expenses for their 3 children. So they're still limited to $16,000 though. Remember, it's 2 or more children. Susie received $2,500 of dependent care assistance through her employer. So how that works, Susie has had $2,500 deducted from her paycheck, and it's been sheltered from tax. That $2,500 went into a separate account, and then when she incurs child care expenses, she gets to pay it from that $2,500. But it's been sheltered from tax when it was deducted from her paycheck. So we can't include the $2,500 because it's already been shielded from tax, right? We already got a tax benefit from that $2,500. So the amount of employment-related expenses that they can use to determine the credit is $13,500. Why is it not $2,500 or $21,400 minus the $2,500? You have to subtract it from the maximum credit that would be available to them.
Okay, so we're gonna take the 16,000. So even though they paid 21,400, the max, we're gonna start with that 16,000. Again, it's more than one child, so. And then we had some dependent care expenses. Some pre-tax of 2,500. That leaves us with a maximum of 13,500. Again, that we already had a tax benefit from that. Now, let's look at their income. Their income, they don't go this far in this problem, but we can do that. We've got the table. So their income is $240,000. We look at the table. 240. Wow. Okay, 183 to 400,000. That's a big jump between those two. 20% of 13,500 is what they get. Which is, what is it, 2,700? Get a credit of $2,700. So they started out with those expenses of 21,400, limited by the first number is 16,000. Have to reduce it by any pre-tax dependent care, and then multiply it by the applicable percentage. These percentages are also much more generous than they were. So the percentages that were applied before 2021, it didn't go up to, like, if your income was 125,000, even if it was, I think, like about 60,000, 20% would be what you would get. It was only individuals that were super low income that got the 50%. I can't even recall if it was 50%. All right, let's look at Sophia and Elijah. They paid $3,800 in qualified employment-related expenses for their dependent daughter. So now we've got one daughter, right? So we've got one child. So this isn't going to be 60,000 anymore. Now it's going to be 8,000, right? And we don't have any pre-tax amounts here. So 8,000 is going to be the max that we can take. Maximum amount. They paid $3,800, so they're not going to be able to use 8,000 because they didn't pay 8,000. So 3,800 in qualified expenses. Their AGI was $42,000. Sophia made $40,500. Elijah had net earnings from self-employment of $1,500. That doesn't mean that he just made $1,500. Remember, if you think about that's our net income on that Schedule C. So he could have made $100,000 and had $98,500 of expenses. But his net income is $1,500. This is the income from the lowest earning spouse. Earned income, lowest earning spouse. All right. So in this case, our qualified employment-related expenses is going to be the lowest of these three. $1,500. They made $42,000. We would multiply that by 50%. That's their percentage on that table. They get a $750 credit. Okay, so we're going to compare those three. So what's the maximum they could get? How much were their qualifying expenses? And what is the earned income, or the deemed earned income if it's a full-time student, of the lowest earning spouse? We're going to choose the lowest of those options.
let's look at this next example here. Ethan and Riley paid $4,200. Okay, so okay, so it's one dependent son. Okay, they paid $4,200. Ethan's AGI was $42,000. Riley was a full-time student for 9 months of the year. All right, it's one child, so what we get to do is take 250 times the months that she was a full-time student. So 2250 is her deemed income, and this is the deemed income from the lowest earning spouse. That's the amount that we're going to apply for the credit. The qualifying expenses times 50%. What is that? 1225? No, 125. 1125 for their credit. Okay. Questions about that? So again,
The 250 was what she made each
No.
month?
this is her deemed income. She was a full-time student.
Oh,
One child, so $250 a month. If there had been 2 children, then the deemed, this would be 500 times 9, 4,500. Now this becomes the lowest number. Okay. If they had, so let's just say we had 2 children, our max is 16,000. We had qualifying expenses of 20,000. And the earned income from the lowest earning spouse was 40,000. We would use the 16,000. Apply the percentage to that amount. Does that make sense? All right. Now, like I said, don't get too attached to this because it's changed in 2022. Okay. Let's see. Is there anything else I want to say about it? Let's see. Okay, so a couple other examples. Chang, AGI of 88,744, spent 1,240 on qualified expenses. So he would be entitled to 50% of that. If his AGI were 133,744, now we're gonna look at a different percentage. It would be 45% rather than 50%. So same thing with Rachel there. This is the form that's used, the 2441. Let me pull up the. Okay, so the part 1 here is information about the provider. Again, this could be an individual or it could be a care facility. Right, and if it's an adult, it could be an adult care facility as well. So let's say Mary Smith. We need Mary Smith's address. Here we go. We also have to have Mary Smith's social security number or taxpayer ID number or employer ID if she runs a business and has an employer ID number. This is required. You do not get the credit if you do not have their social security number or employer identification number. So if Mary Smith refuses to give it to you, you're out of luck, but you should probably find somebody else to watch your kids. And then you indicate how much did you pay to Mary Smith? 5,000. Okay. Also, there's these check boxes. These are only for 2021.
essentially, the only thing you had to do to make it refundable is your principal place of abode has to be the US for more than half of the year. Okay, so we paid $5,000 to Mary Smith. Now, that's the first part. Second part is information about who received the care, who's the qualifying individual. We'll say Joshua, I don't have a son named Joshua. Jacob, I don't have a son named Jacob. So, 9, 8, 7, 6, 5, 4, 3, 2, 1. 7, 6, 5, 4, 3, oops. And then, how much did you spend on each one? Well, obviously, this needs to add up to whatever this is. Right? So maybe we spent 3,000 on Joshua and 2,000 on Jacob. That's fine. And it could, if you've got more than one kid, you could also continue it on a supplemental schedule. Add the amounts in column C of line 2. Don't enter more than 8,000 or 16,000 for 2 or more. There's our limit. All right, so our ours is 5,000. Enter your earned income. Oh, let's see. 40,000. If married filing jointly, enter your spouse's earned income. Let's say 4,000. Enter the smallest of line 3, line 4, or line 5. Those are our 3 right there. The maximum, the expenses, the maximum, line 3, 4, or 5. This would be, we would choose whichever was higher of the actual or the max in this line here. Okay, so whichever one is lowest, that's 4,000. Enter the amount from Form 1040, line 11. That's our adjusted gross income. So we'll say it's 44,000 on the other income. And then apply that to, look at the chart. The chart's in a different place. And apply the correct decimal. So in this case, it's 50%. Apply line 6 by the amount on line 8, 2,000. We're not gonna worry about that. Add lines 9A and 9B, there's nothing there in 9B. This is your child independent care credit. Enter this amount on Schedule 3, line 13G. Now we're gonna transfer it over to Schedule 3, line 13G. Oops. 2,000. So you'll see the Schedule 3 is what we use for credits. We have Part 1, which are non-refundable credits. Part 2 are refundable credits. Okay. Again, refundable credits can go below, take you below 0. It's as though you paid the money. So your total would go down here to add up all of the credits. If we didn't have any up here, maybe we'll keep this open because we've got some other credits we can like this. So this was from line 11. What's that? Oh, line 11, non-refundable credit if you didn't check the box on line B. So we did check the box, so we don't have any amount. So if you weren't, if your principal place of abode is not the United States for more than half of the year, you do not qualify to be refundable. Now, then it's a non-refundable credit. This particular credit has always been a non-refundable credit, but for 2021, it's refundable. Okay, so that 2,000 then goes to Schedule 3. Questions?